In news that just broke slightly earlier, Alibaba rolling out its second major cost cuts for cloud services in years, aiming to win back users from rivals like Tencent. The move comes as competition intensifies to provide the tools critical for training AI. Let's get to Bloomberg Intelligence, Robert Lea. He joins us with his reaction. Does look like Alibaba getting aggressive in fighting for its own turf.
No, absolutely. But my sort of initial reaction on this is sort of here we go again, because Alibaba tried this strategy last year. And when they reported their year-end numbers, their cloud growth or cloud intelligence growth for the fourth quarter was up in the low single digits. So it's a strategy they've tried before, as others have, and I think the evidence speaks for itself. To be fair to them, though, what other choice do they have at the moment? They're trying to stimulate growth within this business. So in order to increase their share or drive their business, then price cuts is an obvious way to try and do that. But going into a slowing economic environment, I'm skeptical that this is going to deliver material results to them.
So what should be the follow-up action? I mean, a price war doesn't always work well, like you said.
Yeah, and the China tech sector is sort of notorious for these. You think China, for example, is the global leader in solar panels and LEDs, but as a result of too much capital going into those sectors in previous years, they're all loss-making, or they certainly were loss-making, or making very low levels of profit. So I think there are parallels to be drawn with the cloud sector here. Absolutely. Yes, trying to stimulate growth is what we're going to do. I think the only other option available to them, but it's obviously not their decision, would be some sort of government stimulus coming in to try and stimulate growth within a sector that's sort of key to building out the national infrastructure, etc. And that's something we possibly might hear on next week with the MPC reporting in Beijing.
And in the broader tech space, Baidu out with numbers. What do the earnings say? Some say that, 2024 is a make or break moment for the company.
Yeah, that's one way of looking at it. I think, as I've said before, the reality is Baidu is China's leading search engine. However, that is a mature business, again, going into a slowing economy. The major driver of revenue for the business, so the core business, is advertising related. So again, as corporates tighten their belt in the new year, advertising revenue is going to be harder to come by. So I think that was one area of concern on the results last night. The second being that whilst their AI-related businesses, and particularly ErnieBot, are beginning to deliver more revenue, I think the management spoke of 3 or 4 billion revenue in renminbi terms or yuan terms this coming year. But that's a drop in the ocean for a business that generates 130 billion plus. So the level of revenue they're generating on the AI side is going to be quite low. And in aggregate, their AI businesses are loss-making, and those losses will continue. So they've got great intellectual property. AI is clearly in vogue across the globe at the moment, but we're not going to get the earnings kicker come through for Baidu. And therefore,
right.
That's one cause of disappointment.
Before we let you go to enjoy your tea, NetEase out with results today. What is expected? We know that the bar is high.
Yeah, the true Englishman enjoys his mid-morning cup of tea, but hopefully it's not got too cold. Yeah, NetEase tonight, they had a stellar year last year, blowout numbers expected. But you look at consensus numbers, the growth is coming to a complete halt. I mean, that's the nature of the video game sector. You've got to keep the hits coming. So I think it's a year of sort of stagnation, if that isn't too strong a word for them. They're going to plateau into the next year. So I think, again, that's the area people will focus on.
Rob, thank you. Robert Lea, Bloomberg Intelligence.